Have you ever opened an option chart and felt like you accidentally opened NASA dashboard? Relax, don't worry, because in this video, we are going to understand each line one at a time. Welcome back to another video of StockShaala by Kotak Securities. If you trade in options without understanding payoff diagrams, then it is basically like you're playing chess without knowing what exactly the queen does. So today, we'll learn how to look at your risk to reward visually and understand each of the parameters in a simple and understandable manner so that you can effectively use them before you deploy your money in real trading. A payoff diagram basically shows you profit or loss visually. It's basically a simple XY graph. Let's go to the whiteboard to understand it better. Here, as you can see, we have a simple x-axis as well as a y-axis. On the y-axis, we have a center 0. We have profits on the top. And we have losses below 0. And on the x-axis, we have the various possible strikes for stock or index, basically the underlying. So your question right now is, Pranav, why exactly do we need this graph? Let me give you an analogy to help you understand the importance of this. Imagine you're getting into a business and you are one of the major investors. What are the things you would look at before entering into that business? You would look at what is the break-even point. You're also going to think of what is the worst case scenario and also the best case scenario. Similarly, trading is nothing but business. So here, we also should know what is going to be our worst case scenarios, our best case scenarios, as well as our break-even points. And that's exactly what this payoff diagram is going to help you with. In addition to that, you will also be able to develop and deploy strategies using payoff diagrams. It will not only give you the worst case scenario, but for example, let's say in an option selling position, there is unlimited loss potential. Now, if you have to convert that unlimited loss potential into a limited loss potential, then there are strategies that you can deploy, and that can be visually seen on the payoff diagram even before you enter the trade. Without options, let's take a simple example of equity and see how we can represent that using an option payoff diagram, or basically this profit and loss graph that we have here, right? So imagine you're buying a stock at 100 rupees, and now we have to basically look at the profit and loss of how it's going to be. So as and when the price goes higher and higher and higher, our profit also linearly goes higher. But as and when the price falls, our loss also linearly falls. So this is basically like linearity that we have in terms of pure equity. But now let's also draw a graph of an option contract and see how it is very different from a normal equity graph. Now let's say I buy a call option for the exact same stock. So the strike price is going to be rupees 100, and the premium that I'm going to pay to enter this specific contract is rupees 5. And this is a call option. So let's see how it is going to pan out. Now let's go a little bit in detail and understand this example with more understanding. Now starting with this, to enter into a call option contract, we know that we have to pay a premium. So that is rupees 5. So the maximum amount of money that I can also lose is just rupees 5. So I'm gonna mark 5 rupees over here, and that is going to be my maximum loss. Now if I have to break even on this specific strike, then I have to make 5 rupees extra than what I'm going to enter. So which means my break-even point is going to be my strike price plus the premium that I have paid, that is 100 rupees plus 5 rupees, that is 105. So here, if I mark 105, that is going to be my break-even point. So let me draw this. Okay, so this is how it's going to look like. Now, once I have crossed 105, you also know that for call option buying, we have unlimited upside. So as much as the stock goes higher and higher, my profit is also going higher and higher. So which means my profit is also going unlimited with respect to how much the stock can move. So here you can see there is a clear difference between the curve of equity versus curve of options. So now you see that until now, whatever I mentioned in call options, put options, buying and selling, everything used to, be imaginary. But now you're able to visually see that in the form of a graph and exactly understand what are the risks and rewards associated. So it's like upgrading from a roller coaster which does not have seat belts to now having seat belts and safety gear. So now that you know how payoff diagrams work, moving forward, we will learn how spreads and different strategies can be created and deployed using payoff diagrams. Now we'll talk about the most important metrics when it comes to a payoff diagram. The first one is called maximum profit. The second one is maximum loss, and the third is break-even point. Now let's get to the whiteboard, and in the graph that we drew earlier, let's find out these three metrics. So now the three important metrics are maximum profit, max loss, and break-even point. So let's first identify the maximum profit. So in this case, we identified that the maximum profit here is unlimited. So that's the first metric, maximum profit, which is unlimited. Now the second one is maximum loss. You know that in a call option, the maximum loss is to the extent of premium that you have paid. So in this case, it was 5 rupees that we paid, and we have also marked the same here. So the max loss is rupees 5. And finally, the break-even point for a call option is given by the formula your strike price plus premium paid. So here in this case, our strike price was rupees 100 and the premium paid was rupees 5. So that is going to be 100 plus 5, that's going to be rupees 105. So when the stock goes above rupees 105 at the time of expiry, then that is when you're going to be breaking even or profitable. So here are a few mistakes that you have to avoid as a beginner. Number one, don't confuse between your strike price as well as the premium paid. Strike price is basically the strike that you have chosen while entering the contract, whereas the premium is the amount of money that you pay to get into the contract. The other mistake that beginners also should avoid is thinking that the call sell is same as call buy. In the upcoming video, I'm going to do a detailed video on understanding the payoff diagrams for a call sell versus call buy. So that should help you understand differentiating the two. Another mistake to avoid is ignoring the value of time value and decay. It is very important for you to consider these two values while you're entering into a trade. And finally, you have to make sure that you're not only looking at the current price, but you're also considering the value at expiry using the formula for intrinsic value for both call option as well as put option. Backtest your strategies, but more importantly, graph it before you trade it. So here is a quick recap of what we have learned so far. We understood what exactly is a payoff diagram. It's a visual risk calculator and also tells you the three important metrics, that is your maximum profit, maximum loss, as well as break-even point. It is very wise to use an option payoff diagram before you enter into any strategy or while building an option strategy. And most importantly, I have shown you that you don't need fancy tools or softwares to draw payoff diagrams. In fact, you can do it with simple tools like a paper and pen. Now that you have understood how exactly a payoff diagram looks like and how it works, now let's dive deeper in the upcoming videos to understand how the option diagrams looks different for a call buy, call sell, put buy, put sell, and different spreads as well. Go ahead and like this video if you understood what payoff diagrams are, and in fact share it with your friends who are trading without payoff diagrams. You're watching StockShaala by Kotak Securities. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.